This is the story of how a U.S. naval blockade in the Middle East has created a diplomatic trap for China, and why silver investors need to understand what's unfolding right now. At 10 a.m. Eastern on April 13, 2026, the United States Navy began enforcing a blockade of all Iranian ports along the Arabian Gulf and Gulf of Oman. Over 10,000 U.S. sailors, Marines, and airmen backed by more than a dozen warships and dozens of aircraft are now executing that mission, and Trump's message to the world carried no ambiguity. Any ship approaching the blockade would be, in his words, immediately eliminated. That order came after 21 hours of failed peace talks in Islamabad collapsed without a deal, after a ceasefire that produced almost no actual traffic through the strait, and after oil prices had already climbed more than 40% since the war began on February 28. What most coverage skips past is who absorbs the most pain from all of this, and the answer isn't Europe or Japan or the Gulf states. The answer is China. China accounts for 37.7% of total oil flows through the Strait of Hormuz, more than any other country by a wide margin, and about half of its entire seaborne oil supply moves through that same corridor. Nearly one-third of its LNG imports do too. Last year, China bought more than 80% of Iran's shipped oil, roughly 1.4 million barrels every single day, and when the strait closed, that relationship became both a lifeline and a liability. Iran understood exactly what that dependency meant. In early March, Iranian authorities announced they would allow only Chinese vessels to pass through the strait, and a bulk carrier operated out of Shanghai transited the waterway while broadcasting China owner as its identifier. That arrangement bought China some breathing room, with analysts at Kpler noting Chinese refiners were sitting on roughly 120 days of oil cover, and OCBC analysts pointing to China's massive strategic reserves and its expanding electric vehicle fleet as structural cushions against a prolonged closure. None of that changes where the trap snaps shut. The U.S. blockade doesn't just pressure Iran in isolation. It corners China between two relationships it cannot afford to lose. Beijing has deep financial ties to Tehran, its largest oil customer, and those toll payments Iran collected from passing tankers were being denominated in Chinese yuan, not U.S. dollars. But China also cannot walk into a direct confrontation with Washington, especially with a Trump-Xi summit now scheduled for mid-May. Within hours of Beijing's foreign ministry declaring the blockade dangerous and irresponsible, a U.S.-sanctioned Chinese-owned tanker called the Rich Starry sailed straight through the strait anyway, and that single moment exposed the contradiction China is living inside. Condemn it publicly, navigate it privately. U.S. intelligence also suggested China was preparing to deliver new air defense systems to Iran, which Beijing denied, and Trump warned that any country supplying Iran with weapons could face tariffs reaching 50%. Capital Economics chief economist Neil Shearing framed the central danger clearly, writing that the blockade risks creating new potential flashpoints, and asking the question nobody wants to answer. Would the U.S. Navy actually seize or sink Chinese vessels in the strait, and would either outcome trigger a historic escalation? China and Russia had already vetoed a UN resolution to reopen the waterway, and Xi Jinping put forward a four-point peace plan built around sovereignty and international law, but the ceasefire is set to expire around April 22nd, and the window for diplomacy is shrinking. Now here's where silver enters the picture, and the price behavior has surprised nearly everyone watching. When the war began on February 28th, silver spiked to $96.40 an ounce, which made sense given the scale of the geopolitical shock. What came next did not follow the expected script. By early April, silver had retreated to around $71 an ounce, and on April 13th, the day the blockade took effect, it was trading around $74. Rising oil prices drove U.S. inflation from 2.4% in February up to 3.3% in March, and that inflation surge pushed bond yields higher, strengthened the dollar, and forced markets to price in fewer Federal Reserve rate cuts. The result was a flight to liquidity rather than a flight to safety, and silver absorbed the hit. J.P. Morgan had projected silver would average $81 an ounce across 2026, more than double its 2025 average, and that context matters because silver had already surged over 130% in 2025. The structural story underneath the daily price moves hasn't changed. Solar panel manufacturing consumes approximately 130 million ounces of silver annually, each panel requiring 15 to 20 grams for optimal conductivity, and every electric vehicle manufactured requires significantly more silver than a conventional car. The global silver market ran a deficit for the sixth consecutive year in 2026. Supply hitting a decade-high still wasn't enough to close the gap. And in just the first 2 months of 2026, China's silver imports surged past 790 tons, a sharp reversal from its position as a net exporter just a year earlier. China's role in all of this is difficult to overstate. The country manufactures 60% of the world's electric vehicles, purchases 50% of new EV sales globally, and controls more than 80% of the solar panel supply chain, with government mandates requiring 40% of all new vehicle sales to be electric by 2030. All of that production runs on silver. One counterforce is accelerating, though. Silver's share of solar module production costs climbed from 5% to 14% in just 2 years, a 280% relative increase that forced Chinese manufacturers to act, and Longi Green Energy announced mass production of copper-based solar panels beginning in Q2 2026, with Jinko Solar signaling the same shift. Bloomberg NEF projects silver demand from solar panels will fall approximately 7% in 2026 as that substitution picks up speed. The industrial demand case is real, but it carries conditions. Here's what ties all of it together. Trump's blockade isn't purely a military move against Iran. It applies maximum pressure to the one country that depends on that strait more than any other, putting China in a position where backing the US means betraying its relationship with Tehran, and backing Iran means risking 50% tariffs, a collapsed summit, and potential confrontation with the US Navy in international waters. Beijing is caught between two dependencies it spent years building, and now neither one offers a clean exit. Silver, trading well below its wartime peak of $96.40, sits at that same intersection. Not because the crisis resolved, but because dollar strength and inflation expectations ran faster than safe haven demand in the short term, even as the structural deficit, the industrial build-out, and China's stockpiling activity continue operating in the background. The ceasefire expires around April 22nd. Talks may resume or they may collapse. And what happens next in the Strait of Hormuz will shape more than oil prices. It will define the trajectory of US-China relations, the pace of the global energy transition, and where silver moves from where it sits today.